All right, good afternoon, everybody. Hope you're doing well. Hope you're having a nice week so far, and you had capitalized on the opportunity yesterday from the US employment cost data. FMC, we've got about 45 minutes or 44 minutes till we get the rate decision at the top of the hour. But let's get into it with the rates, what to expect, what's been said before, what are investment banks saying, what a Fed official said in the past, and what was the deviation like beforehand, and what was the sentiment or what caused the market to move in a certain way. So with the rate decision, it is the FOMC meeting roughly every 6 weeks over a 2-day period to set policy and the federal fund target range. Some months or every 2 months you get the summary of economic projections where they provide more in-depth data as in a view and their expectations of where they see GDP, growth in general, and inflation, and where they see the federal funds target being in the future. Now, of course, this is also the rate that banks charge each other to borrow or lend excess reserves overnight. So why is it important? Well, of course, it causes market volatility and affects the wider economy. And it can also influence other central banks to follow in a rate path or follow in a similar way of being either more hawkish or more dovish, or taking parts of what the Fed is doing into their own monetary policy stance. So how does it affect the markets? What do you guys need to know? For the currency, there are things, and this is not just for the currency, but stocks and bonds, but for everything. Can you hear me? Eric Harper, can you hear me? Said speak into the mic. Have you turned your sound on? Should be able to hear you. Hear me? Okay. Oh, it was soft at first. Well, the engine is on. It's running. Kind of let the engine warm up a bit, but we're here. All right, so let's carry on. So the thing we need to understand with how the markets are affected, there are two things that are going to affect the market. Of course, that's the market, that's the rate statement and the interest rate decision. The interest rate, of course, is expected to remain on hold and probably maybe till September or even November or December, as when we might get the first interest rate cut from the Federal Reserve. Then, as said, there is the statement of what the central bank says that will have an influence on what the markets do. So if the rate, let's say, comes in as expected, then markets will be looking to the rate statement for any further clues of if the central bank is being more hawkish or dovish, to then provide themselves an opportunity or an indication of how they should trade the markets. Okay, so with the currency market then, if you have a more hawkish than expected central bank, or if they decide to raise interest rates more than expected, or raise them when they were not expected to raise interest rates, then you would have more of a bullish reaction from the dollar, because of course rates are likely to be held at a high point for longer rather than being reduced. Or there's also if the central bank does raise rates, if they do decide to raise rates, then of course the currency goes up in value because international investors will pile their money in to the US market because the money is more valuable and they get more back from investing in bonds. So you have a lot more flowing into dollars because of that very reason. For the stock market, quite obvious. If the central bank is more hawkish, you have the flip side of what happens in the currency market. Stock market takes a hit if the central bank is more hawkish than expected. However, like last time, if the central bank is seen as dovish or isn't as hawkish as the markets might have expected them to be, then you see a positive reaction or more of a bullish reaction from the stock market instead. So last time what happened is that the central bank still saw 3 interest rate cuts this year, when markets were worried about data maybe cutting that down to 2 or maybe even 1 interest rate cut this year from the summary of economic projections. Hence, you had a more positive market reaction. So more of a providing a bit of relief to the market that caused that bullish reaction on stocks. For bonds, bond yields will typically see a stronger or more bullish reaction if the central bank is seen as more hawkish, meaning that, of course, if they're having to hold rates for longer at a high rate, or they may have to cut less than what was previously expected by the markets and the central bank itself, then it provides a more bullish upside move towards bond yields, particularly the shorter term rates, because those are the ones that are most affected by what's going on within the economy and are more sensitive to market reactions, such as the two-year bonds. Okay, so where is the economy at the moment? What is the Federal Reserve looking at? What data do they have? Of course, they can have other bits of data and mathematical geniuses, which I'm not, unfortunately. But what is the Federal Reserve looking at? So you had GDP data Q1 at 1.6% compared to 3.4%, which provided a mixed reaction from that weaker than expected data. Inflation was at 3.5% compared to 3.2%. Core inflation remained unchanged at 3.8%. PCE price index year on year at 2.7% compared to 2.5%. Core PCE remained unchanged. Consumer spending also unchanged as well. Non-farm was at 303k, which we have this Friday, and I will be there. Last time I wasn't due to coming down with a sickness. Compared to 303k compared to 275k. ISO manufacturing PMI, which we had today at 49.2 compared to 50.3. Remember, key thing with the PMI figures is 50 or above shows the area is in expansion. Anything below that shows contraction. So going from expansion into the contraction area for manufacturing data for manufacturing in the US. Services PMI 51.4 compared to 52.6. UMIC, or the sentiment survey, was at 77.2 compared to 79.4. 1 year inflation ticked up to 3.2% compared to 2.9. 5 year inflation expectations ticked up to 3% compared to 2.8. And employment costs, what we had this week, what we had yesterday, was at 1.2%. Remember, that's quarterly data. So there is a bit of a lag in how much, there is a bit of a lag in the representation of that figure when it does come out. But the markets did react to it because of the fear if employment costs are going up, that might mean that if employees have higher wages, then that will lead to more spending. And if that leads to more spending, then that could lead to inflation ticking back up again or even further. Although it is a 1 quarter of a report it is representing 1 quarter, it could still be enough to keep inflation in the 3% range, maybe for the majority of the year, or enough to keep it away from the 2% target the central bank is looking for, and a nice disinflation path that they would want to or hope to get. Okay, the previous FOMC. So if we look at what was said before the last FOMC, or the latest statement of what we had. So back last year, the committee judged that the risks to achieving its employment and inflation goals are moving into a better place, and the economic outlook is uncertain. They don't expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably towards 2%. And they also say the inflation has eased somewhat but remains elevated. Now, the one from March 20th, or the last meeting, they said that policymakers still project, well, overall from the SEP, policymakers still project 3 rate cuts this year, even as inflation remains elevated. And they also updated their projections as well for CPE, or the Consumption Expenditure Price Index. So the Fed, where their quarterly projections showed PCE index excluding food and energy, or core PCE, rising at 2.6% by year end, compared to 2.4%. They also said that new policy view also raised the outlook for US economy, and policymakers now see growth at 2.1% compared to 1.4% projected in December. And inflation has eased over the past year, but remains elevated. So this is a key thing that we have to understand about the language change here. The one before that said inflation has eased somewhat, but remains elevated. In the latest one, they say inflation has eased over the past year, but remains elevated. So removing the somewhat part, which provides that bullish aspect for the stock markets, because it means that the Federal Reserve doesn't have to do too much work. On top of that, the reason why the markets were seeing that bullish reaction, as said, was because they still saw 3 rate cuts within this year that were going to occur. But of course, now the picture has changed. It's probably going to be 1, maybe even 2. It depends on how confident the Federal Reserve is, and of course how inflation plays out. So the meeting minutes from April 10th, participants generally noted recent data had not increased confidence that inflation was moving sustainably down to 2%. Some participants noted concern that financial conditions might not be as restrictive as desired, which could put upward pressure on inflation. Don't forget, if you find this video and information useful so far, and it's helped you understand the Fed's rate decision much better, then don't forget to give the video a like, share the video, subscribe to the channel, get the word out there, bring in your friends, and let them listen to the wise words of Tony from MACROACE. All right, so Fed members then, what have they said? On April 18th, you had Bostic saying rate cuts may be accelerated if inflation drops faster than anticipated. Williams said that the Fed is data dependent and that the data has been very good. Mester on the 17th said that inflation is slightly higher than anticipated this year. Fed's Powell said that if higher inflation persists, then the Fed can maintain current rate as long as needed. Fed's Collins said that I now see the Fed cutting later than previously thought. So there are some other comments too of Fed members being more pessimistic about the 2% inflation goal, which adds to the bets that the central bank isn't going to cut rates as much this year. So what does that mean for us when we're looking at when we do get the new rate statement? Well, if these members have already said these comments that are more pessimistic about the inflation goal and rate cuts, markets are going to be pricing that in already. So that means a lot of the moves that you may expect from the statement would have already happened beforehand, because markets have been fed information about what they could expect from the rate statement. So when we're looking to trade the rate statement, the rate statement, we're looking for something that's going to surprise the markets. If that is maybe looking at no rate cuts this year instead, or that's for the hawkish side and would provide a bullish reaction to the dollar and a bearish reaction for the stock indices, or the stock indices, stock market. On the flip side is if they say, or if they feel that maybe they can cut rates soon compared to what they've said in the past of not being so confident, which would be a flip side to what they've been saying, the opposite of what they've been saying so far, and being pessimistic. And that would provide a bearish reaction for the dollar, more of a bullish reaction for the stock indexes. So investment bank views then. So Goldman Sachs, they noted that the employment cost data rattled markets as it came in above expectations, fueling the persistent inflation and no Fed cuts narrative, leading to a sharp sell-off in US equities as 2-year yields pushed up through the 5% level that are capped for most of April. However, in a piece this morning, they discussed that the portion of yesterday's wage growth reflected a lagged catch-up. Again, it's not fresh data. It's getting data from over a quarter rather than, let's say, at the end of the month or the week after the data has been everything's been compiled together when the data has been released. But it instead shows a reheating of the labor market, and that it wouldn't really change the big picture on the inflation view for Goldman Sachs. And they're still expecting the next few inflation reports to be softer, and have therefore stuck with the forecast of cuts in July and November, which is pretty, well, we're getting closer towards it. Can you guys not hear me? Have you guys turned your sound up? Somebody else said, is someone there? I've been here for the last, I don't know, 25 minutes? Bright, what do you want about? Tell me. If you haven't turned your sound on, or maybe you're talking about in the chat. Okay. Okay, cool, good. I'm glad you can still hear me. All right, so let's carry on then. So as I said, Goldman Sachs still expects July and November as for when the first rate cut, was when the rate cuts could happen. So 2 in total. MUFG, they said that the Fed is expected to send a more hawkish signal over the outlook for rate cuts, similar to recent comments from Fed Chair Powell when he indicated that recent data have clearly not given us greater confidence and instead indicate that it is likely to take longer than expected to achieve that confidence that inflation will return to target. The Fed may need to see a couple of weaker reports from CPI before cutting rates. So that puts out the discussion or the point of a July rate cut that takes it out of the picture. If, according to MUFG, if that's what the Fed is going to be looking for, then that's less likely to happen. Or if data is stronger than what the markets had expected, and if you start to see, let's say, a reflation or inflation starting to tick up further. I said in my email that if inflation starts to head back towards, if it starts to go higher and maybe into the 4%, then if inflation goes towards 4%, the idea of a rate cut is dead in the water, probably for the year, and maybe 2025 then becomes the first point when the central bank decides to cut interest rates. So it's still a waiting game as it always has been, but now the next couple of reports are going to be more sensitive, or the markets are going to be even more sensitive to what happens for the next rate decision, or the following rate decision from this one. Morgan Stanley, they say that little change is expected from the statement, but we see the risk of a more hawkish press conference. Emphasis should be remaining patient as the FOMC awaits more convincing inflation data. JP Morgan, they said that recent upside surprises on inflation likely have been much more important for Fed policymakers than the downside surprise on Q1 GDP data, especially considering that stronger inflation news has come alongside upside surprises in terms of many key labor market indicators. With all of this in mind, they still think the FOMC likely lacks the confidence needed to lower rates or signal that rate cuts are coming very soon. So again, remember, these investment banks already share the feeling that, or most of them, besides Goldman Sachs, that a July rate cut isn't on the table and that the central bank needs more data to be confident before they make a decision to cut rates. So if these comments have also been said similarly by the Fed members, then it's going to be priced in. So if the rate statement more or less confirms that the Federal Reserve isn't ready to cut interest rates, then the size of the reaction may not be that big. There may not be that much volatility that's there. That's going to be sustainable enough to then capitalize on the opportunities to the market. All right. What else we got here? And then TD Securities, they said that they expect the Fed to cut interest rates twice this year, and they expect the Fed to start cutting interest rates in September. Okay. And then market pricing. And then I see people do have some questions or thoughts. I'll get to that. This is the last little bit before I go on to that. And I've got the deviations to go through as well. April 26th, post the PCE data, traders of rate futures contracts price in a firmer chance Fed will deliver the first rate cut in September. Fed swaps fully price in a rate cut before December, so no longer fully price in a rate cut before December. Short-term interest rate futures drop after Powell says restrictive policy needs further time to work, and traders of rate futures reduce their expectations for the Fed to cut rates more than once this year. Okay, so let's get out of this here. Let's get to the deviations. Let's bring that down. Okay. So if you don't have access to the ranges and deviations sheet, well, let me explain to you what it is first. It explains to you, or it shows you how much the markets have reacted to rate decisions and other economic releases that occur. So here we're looking at the FOMC rate decision. We can see here the market reaction for the S&P, the US indices, gold, the currencies, and also the bond market and Bitcoin too, which is a recent add. But alongside that, with the rate decisions, you get, so let me summarize that again. It shows you how much the markets are reacting to the economic releases. Okay, so here, this box that you see here, which is showing the S&P 500's reaction, this initial market reaction shows you that there was 61 ticks towards the upside. That's going to the wick of the candle. Here in the black brackets, it shows you the market reaction 10 minutes after the release has occurred, going to the end of the candle. And then here in the blue brackets, shows you the market reactions, 30 minutes after the release has occurred. So you can see there was 61 ticks towards the upside initially, going to the wick. After about 10 minutes, it ticked higher to 86. And then after about 30 minutes, it kind of dropped down a little bit, not too much, to 82 ticks as its market reaction after 30 minutes after the release. Okay, so we can see if we're looking at the currencies consistently, we've seen that the dollar yen has had the biggest market reaction. Not only is it one of the most traded, but of course with how the Bank of Japan has been seen as, well, now they've started raising the rates this year, but they are taking a bit more time than other central banks to raise interest rates. other central banks are looking to ease monetary policy. So there's the flip side. There's a flip side that's occurred now. But the dollar yen has still consistently seen the biggest market reaction, besides maybe here in November, where it was cable that had seen the biggest market reaction. So dollar yen, then we have cable, euro dollar. And if we're looking at the bond market, then you see the 2-year bond price, or ZT, that's seen as said, is the most sensitive out of the bonds. So it's seen the biggest market reaction there. Alrighty. So if you want access to this, to be able to see updates to what's going on, or how the markets have reacted to economic releases, if you haven't signed up to the mailing list yet, all you got to do, sign up to the MACROACE mailing list here. Okay. Bing. There we go. If you sign up to the MACROACE mailing list there, then next week on Monday, you'll get not only the ranges and deviations sheet, but you also get a little email as well of what to expect for the week ahead. Let me just show that email to you here, if it wants to. Oh. Where is it? Okay. Yeah, so here we go. So here's what the email looks like. It's quite short in regards to, in terms of, well, this isn't the latest one. Let me see. No, okay. But yeah, so here is an example of one of the emails. You get a bit of a indicator of what to expect for the week ahead in Asia, Europe, and the US. Summary, a slight summary of what's happened in the past week, if it has been important or noticeable. Well, this is from last year. But yeah, so you get links to the deviations and ranges. You also get links to the live streams as well that we'll be doing for the week ahead. And then if there is a summary of the week in news, or summary of the news so far that's happened, or whatever's happened that's affected the markets, then that'll also be in there too. So as I said, it's a short summary of what to expect and a bit of what's happened in the past week. But it's supposed to act as a refresher. There isn't a lot of detail in there, because the detail comes along with me doing the live streams here with you guys. But yes, if you wanted access to the ranges and deviations, you can sign up to the MACROACE main list, and then you can have a look at the ranges and deviations. And it also, well, I mean, I update it. You can see me updating it live and in real time as well. And you can kind of chop around and have a look at stuff. I used to do images, which was hard to have a read of. It wasn't that great, but we improve, we get better. Okay. I don't know. You might have to check your account settings. I'm no support. You got to just check with those guys. Check with MT. Okay, there are some sound issues that people are having. I mean, I can hear myself loud and clear. This is a bit odd. So some of you must have been, some of you guys must have just been seeing the screen just change and thinking, yes, this is knowledge. This is great. Anyway, so as I'll carry on and we'll get this bit done. So here we had the Fed. So the sentiment was that the Fed raised their GDP outlook and inflation outlook while keeping rate cut forecasts, seeing 3 rate cuts this year, as they had seen in the previous one. Traders priced in additional Fed easing in 2024, more or less firming up how many rate cuts, or the 3 rate cuts, as the central bank is or was expected to do. Now that's 2. So this is also important too. So you see what's been said before and how the markets reacted. You can see when the markets have been a bit choppier, like here. like that. When the rate statement is, sorry, I'm going quite quick. When the rate statement has been a bit choppier, where here it might be a bit more, a little bit hawkish and dovish, the market reaction is choppier, as you can see across on January 31st. March was a little clearer, it's much better because you had other bits of data to look at from the summary of economic projections. Of course, at this meeting, we don't. So we're solely reliant on the statement itself, which rarely changes. So if they repeat what they say of not being confident in the cutting, or not being confident in inflation enough for them to be able to cut interest rates anytime soon, then you might not see that much of a reaction. But if they say that, if they do remove, let's say, if they say that the inflation has been persistently stronger than expected, or still remains sticky than what we previously anticipated, it gives them less room, or that they know that inflation isn't going to come down for the foreseeable future, then again, that could provide a more of a bullish reaction for the dollar, a more of a hawkish statement from the central bank. And on the flip side, if they, for a very dovish side, if they remove reference to them not being confident that inflation is headed towards the 2% goal, which would be a surprise because members haven't really been saying that they're confident that inflation is headed towards the 2% goal all that much. It has been said here and there, but the pessimistic views are growing. So that could then provide a more of a bearish reaction for the dollar and a decline and a bullish reaction for the stock indexes. So it's going to be a bit tough. So when you're trading this, I mean, you can do whatever you want to do, but usually I'll have to wait for what the statement says, understand it myself first, and then make a decision whether or not it's more hawkish or more dovish. Because I could just jump in and just go, yeehaw, cowboy. But that's not, I mean, you can do it, but yeah, that's not the way I want to do it. Otherwise, I feel like I don't know what I'm doing. Okay, right. So that's the ranges and deviations. That's the Excel there, or the spreadsheet. If you want to get access to it, sign up to the MACROACE mailing list, or the link is now gone. There's so many chats that just popped through. Let me get rid of that there. Let's get TICKSTRIKE up and running. We've got about 11 minutes, so I've got time to discuss with you any questions that you might have. Let me just get this all set. Okay. Good. Okay. Put that down. All right. So I'm gonna have to scroll up. Somebody did have a question about somebody's. Is hawkish today? Yeah. Some of these comments of saying, are they going to be hawkish? Well, you don't really know. You can only kind of judge what the Fed members have said. So if they have seemed to be a bit more hawkish in their rhetoric about inflation or rate cuts, or maybe seeing less rate cuts this year, or maybe not even at all, then that gives you an indicator as to yourself that maybe they are expected to be more hawkish. If they're not, then that's great for stock traders, okay, or the equity markets. But it's kind of here. It's kind of hard to predict what the central bank might do. You never know; they might surprise. So you kind of got to just prepare yourself as best you can with what's been said. VWAP, Jesus, you better be making miracles in the markets. Hey Tony, how does the political cycle play into this with the upcoming election at the end of the year? Well, usually the central banks or the Fed hasn't really raised rates before an election has occurred. If I remember correctly, they've been more inclined to cut rates. Maybe I'm wrong on that point about cutting rates all the time, but they have been known to cut rates before an election has come up, or maybe not. I'll have to double check that. But if they were to cut rates because of how, well, they wouldn't really try to help the president of the US. They more or less stay neutral. If Trump wins, then we know, or if he does, well, he probably will become, he is the candidate for the Republican Party. If he wins, then of course that means that, you know, businesses could have a better time in life with less intervention, less government being involved in businesses and in life. And then that in turn, with those incentives being provided to those businesses, could give them more profit and share to then make more money. But then if Biden wins again, then it could mean that we still, that the central bank, doesn't change their course, because they kind of just carry on trudging along with what they're doing. Of course, Trump is going to be more unpredictable compared to Biden. Although saying that, but there have been things that Biden may have done that seemed, okay, that's a bit unpredictable compared to what Trump has done. But again, it doesn't really have too much of an effect. I mean, the election cycle on what the Federal Reserve does. They try to not do anything to inflate or deflate the economy to serve a purpose for another candidate. Unless it's a necessity, then they need to do something. Then that's a different story. Tamuno Emmy says, honestly, I don't understand these things. Key thing you need to understand is read through the statement first, okay, before you make your decision. You can do whatever you want, but if you're new to trading rate decisions or looking at them, read the rate statement, what you're looking for, or do a comparison. Look at the old rate statement and then look at the new one and see what's changed and see how the market's reacted. We know the key focus is on inflation and whether they feel confident or not confident enough to cut interest rates. Okay? So those are the key points that we're going to be looking out for, is if they change their rhetoric, and it could be a slight word change here or there that could mean the difference, and we're not sure what that word's going to be, but we've kind of got to you've got to read through what's been said before you make a decision, or just sit and watch, see what happens. Let's see. Raise access to the sheet. We were supposed to have 3 rate cuts this year, maybe down to 1 or even 0, says Rajan. Yep, down to 1 at the moment. Is anyone still having sound issues? I hope you guys aren't. Let's see, what else have we got? Yeah, we've got about 6 minutes left. So, let's see. Mungus McTavish. That's a cool name. Mungus McTavish. Mungus McTavish. You've been committing crimes against this great nation of ours. Give us your badge and gun. I had to do it, man. I had to do it. McTavish. That's enough. All right, yeah. About 6 minutes ago. So Financial Juice is where we'll be looking at the headlines that come through, and of course on the left hand. So Financial Juice, if you're not familiar with it, Financial Juice is a live voice and text service. Sorry, I'm laughing at the comment. You've been mungified. I don't think I could say the other word though. Anyway, so Financial Juice is a live voice and text service that provides you with up-to-date news on what's going on in the markets, what are central bankers saying, maybe there's a geopolitical event that has occurred, or something has changed that something has changed sentiment within the markets. FinancialJuice provides you with a live, real-time voice and text service to keep you up to date with what's going on within the markets and globally as well. All in real time, all in one place, all in one place. So here you have your live voice feed, okay, which you can see me where I've clicked the button there. You've got your voice slider button there to get live voice. In the middle, you have your text feed to give you all the headlines of what's been said on the microphone, or if there's an article that's been put out on my live streams. On the left-hand side, you have your economic calendar of the upcoming economic releases. Earnings are also due here, which is a new thing, actually, new feature showing you what earnings are expected for the week ahead or a day ahead. Okay. And then we've also added some new features of, you can see here, where we have important articles that we've written ourselves for the economic calendar for the week ahead for US and Europe. And you have the interest rate prep there. Everything's all in one place of what you would need for live voice and text service. As I said, it's in live and in real time to be able to keep up to date with what's going on. So we have an offer for FinancialJuice, for FinancialJuice Pro. And that is, instead of paying $1,200 a year for FinancialJuice, you get a 92% discount. Juicy92, it's a promo code, for FJ for $99 for 1 year instead. Okay, so instead of about $1,200, you're paying $99 for a year with a 92% discount. And if you've played with FinancialJuice before, if you've heard of it, but you're not sure, maybe now's the time. Obviously, if you're ready and you feel confident and you want to, then by all means, go ahead. So this is the link is pinned in the chat at the top for you to have a look at there. Okay, as said, so promo code is Juicy92. You should be able to see it on the thing there. Yeah, you can see it on the website there. Okay, Juicy92 is there with the link to to FinancialJuice. Now make sure you have an account first before you sign up to FinancialJuice. So you would be on the light version. The light version, there is a delay to the service across the website. You do get adverts that do play, but make sure you have an account first and you verified your account from your email. Then if you want to go pro, there'll be a button around here, the top left-hand corner, where I'm kind of clicking the slider here. And then once you've done that, then select the subscription that you want, put it in the promo code Juicy92, and then once you paid for it, log out of FinancialJuice and log back in, and then you get to see FinancialJuice live in real time. Okay. All right. But if you're not ready yet, you can still use the light version to. Okay, we got 1 minute to go, so I will shush my mush, and we'll see how this plays out. So what I'm going to be doing is I'm going to be. Okay, Nico, no worries, buddy. Yeah, Nico, my guy. All right. See, I'll be looking at the statement, and then I'll make my decision as to which way, what I want to do. Okay. And I'm also going to go quiet as well to see. Okay, right. I'm going to go quiet now. Okay. So it was a quick little chop trade. Not much to go off on, but they did say the Fed said that risks to achieving employment and inflation goals have moved towards better balance over the past year, as opposed to are moving into better balance in the March policy statement. So I saw that as a little dovish, a little more dovish, but there wasn't too much to kind of go off on. The rest is more of a repeat of what's been said before. They still don't expect that it will be appropriate to cut rates until it has gained greater confidence inflation is moving sustainably towards the 2% goal, or towards 2%. Economic activity continues to expand at a solid pace. Job gains have remained strong. Unemployment rate has remained low. So, yeah, no real surprises from the Federal Reserve to cause to create a large market reaction here. Yeah, that's it. That's really it. To be honest, so everything's more or less stayed the same. The only dovish point, as said, was that inflation goals and achieving inflation and employment goals have moved toward a better balance over the past year, rather than are moving into better balance from last time. Does that make sense, Tamino? I should do. I won't be trading the press conference because now you've kind of been given the speech of what Powell is going to say, but the press conference could be where Powell maybe does put off the September rate cut, or if they, here we go, traders see Fed rate cut most likely in November now. So that's probably what's keeping that's what's creating the choppy market reaction here. Key thing is that they're still not confident that Fed does not expect it to be appropriate to cut rates until it has gained greater confidence inflation is moving sustainably towards the 2% goal. So markets are looking at treasuries hold gains after Fed runoff pace. Traders see Fed rate cut most likely in November. What else we got here? Treasury yields now extending. Full 10-year yield last time full spot 6.2. So what we got here? The one up a bit higher too. Bond prices went a bit higher. Traders see smaller chance of no Fed rate cut this year after FOMC meeting. Okay. So this has kind of more or less been priced in, which would explain why you're still seeing some upside movement in the indexes because of what the central bank members have said in the past, putting off or being more pessimistic about inflation reaching the 2% goal. So that's what's probably kept the indexes up here from what we've seen with the market reaction. No other big hawkish surprises from the central bank. Oil futures extending losses too. They were down by $3 a barrel on crude oil. US crude. Yeah, but there's nothing else really. Okay. So one little trade. Got out of it because of that red candle. Started to form. Didn't want to take any chances on that. Probably a good idea too. From the way it reacted. All right, so let's get out of this. Put that away. So we have non-farm payrolls Friday, which should be. I'm trying to see what you guys are saying or seeing or saying. Yeah, Rajan's right. The longer we stay here, interest rates, the worse it is. Yeah, less possibility of a cut is bad for the stock markets. Yeah, that's correct. Yeah. All numbers are either negative or the same. See, less positive. Cool. Well, you can't sigh yet. So not yet. I mean, for this rate, for this one, yeah, you can have a bit of a relief. But until the first rate happens, you're probably going to need some meds to keep that blood pressure down. Okay. Right, so Friday we have non-farm payrolls. So let me grab the live stream for the link for that. Don't forget, if you like the video and if you found it useful so far, don't forget to give the video a like, share it, subscribe to the channel, get the word out there, and yeah, and we just build the army that we have. Let me bring it here. I post in the link. Okay, that is for Friday, so you should be able to see that there for non-farm payrolls. And yes, I will be there. So, anyways, thank you very much for joining me live for MACROACE. Don't forget with TICKSTRIKE too. TICKSTRIKE, if you've never come across TICKSTRIKE before, TICKSTRIKE allows you to see how strong the buying or selling momentum is within an asset. So if we're looking at the, let's say, let's get the S&P here. That's what you can currently see. So it shows you the buying and selling momentum visually and audibly as well. So here is what we call the ticker box, or representing the asset. So we're currently looking at the S&P, and you can see the strength of the buying or selling momentum. Okay, and there are numbers which go from 1 to 15. 1 is very sensitive to market reactions, i.e., when there's any bit of buying or selling that goes on, then TICKSTRIKE, as you can see, will give you an alert. If you start to drag that slider up all the way to 15, and you can kind of chop and change whatever you want to do, wherever you want to keep it, all the way to 15, 15 is the least sensitive to market reactions. So only when there's a lot of buying or selling momentum that occurs does TICKSTRIKE give you a visual and audio alert. And as I said, you can kind of chop and change that with whatever you want, whatever works for you. So this is not only for stock indexes, but you've also got currencies, futures, stocks, crypto, your ETFs and ETNs, and internals. It covers a variety of different assets that you can look at, and securities. Okay, all in one place with TICKSTRIKE. Now, actually, there's one feature. So you might have been thinking that it was on level 1. I can see some selling going on, but I don't see TICKSTRIKE updating. Well, there's a feature to actually show that. So here we have the lightning bolt feature. Okay, if I click this lightning bolt, TICKSTRIKE becomes uber sensitive to market reactions. So any little bit of buying or selling that goes on, TICKSTRIKE will give you a visual and audio alert. If I move the mouse away, you will see why. Okay, so it's going crazy nuts. So if level 1 was very sensitive, this is 15 levels below 1. Okay, so like minus 15. And it's uber sensitive. You can see a TICKSTRIKE going off. And of course, you can still do the same thing, chop and change that wherever you want it to be. But if you're scalping the markets, you're doing some extreme scalping of the markets, then this part of TICKSTRIKE is made for you here with the lightning bolt. It's not my style with scalping, but I prefer to not use the lightning bolt. But if you like to scalp the markets hard, then you have this here as a tool to use. As said, you can chop and change whatever. It doesn't have to stay there. You can do whatever you want with it. Okay, so TICKSTRIKE, let me just pop in the link there for you as well. Let's find it here. Dun, 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 dun. Bing. Ooh, the shadow says, "You sound Brit, are you?" Yes, I am from Great Britain. We're from England. Yes, we are British. We are from the UK. You sound Brit, are you? All right, let's see what else we got here. So yeah, that's the link there for TICKSTRIKE. Well, the advantage of for purchasing FinancialJuice Pro is keeping up to date with what's going on with the markets live and in real time, and staying within the know. So the light version of the non-pro version of FinancialJuice, there is a delay to the site, and that delay would have or would most likely have had an impact on the trade you could have taken within the markets, or listening into, or maybe you're looking at how sentiment has changed. If there has been a change in sentiment with rate expectations, or if a geopolitical event has occurred, then there's that benefit of having live real time of FinancialJuice. And everything's, as usual, but everything's all in one place. So the delay on FJ Lite, there will be delay on everything on the website. With Pro, there is no delay and there are no adverts that play at all. So those are the key. And also with FJ Pro, you also get access to the news desk as well. So access to the likes of myself or my other colleagues to ask us what's going on in the markets, what's happened, has there been a headline, that's happened or occurred, has led to this market reaction. And of course, we'll tell you if there has been something, and help you out in the best as best as we can with it. You'd juicy 92 juicy. No, so there we go. I'll put the. Okay, that's the promo code there. So remember, if you're going to sign up to FinancialJuice, make sure you've got a free account and you've got an account with your login details, and you verified your account from your email. Then make your purchase, and then once you made your purchase, log out and then log back in to FinancialJuice. Let's close the text right there. Get it out of the way. Alrighty, ladies and gents. Well, great. That's great, David. I'm using it as I always have financial information from networks in one place ahead of the pack. Great. Can you click on the chart symbol? Oh, on the economic calendar. You're talking about here, right? Talking about that there? So it's history. Well, it's not the. Yeah, actually, talking about Discord, I mean, you guys have been loving that so much. I'm glad that you guys have been enjoying it, and it's proving to be very useful. The rhetoric isn't that dovish. It isn't really dovish. It was only a small point to go for Von, which I took the trade on what they had said about the change in employment goal and employment inflation goal have moved rather than are moving. So there's only a small little change there. The rest is seen as it's still the same, but it's hawkish. But nothing that's a surprise to the markets. Hence you had the more or less mixed reaction, because there wasn't anything new or exciting or anything to cause the markets to go whoa or yeehaw. And you have traders seeing smaller chance of no Fed rate cut this year after the meeting. So yeah, seen as more hawkish. but nothing surprising. Not hawkish enough for markets to see a crazy amount of volatility or bigger moves. Okay. Yeah. A desktop platform. Yeah, a desktop platform. It is something that we've kind of been thinking about, but I think we're trying to make the site first, the feed, as the best it possibly can be, before we start to think of a desktop version. Of course, there are always constant updates, but yeah, changes are coming. When? Soon. All right. Yeah. All right. Yeah, Arno had he had some he had a good video out on the feed. But that would be something yeah, I'd probably have to ask him. Or yeah. So but yeah, anyways, have a great evening or afternoon. It's starting to get warm now, isn't it? I mean, it was cold for the whole of April. Now you decide to pick up some heat, huh? Now you want to burn me and cook me? This heat, great. I kid. Anyways, enjoy the lovely weather if you're having it. If not, then don't. Try to enjoy, I guess. I will see you guys Friday morning for non-farm payrolls at 8 a.m. Eastern Time. We'll go through that prep there. Okay, thank you very much. Take care and goodbye.